This is the Friday, November 27, 2020 version of the Market Plus segment. Joining us now, Chris Robinson and Seth Meyer. We had a different show today because we're recording on Tuesday in light of the holiday. The governor of Iowa has made Wednesday a holiday for state employees. We're produced at a state-run television station, at least part of the state government. And Friday is a light trading day. Wednesday is a light trading day. So, Chris, I'm letting you answer more questions that are broad in scope, but I also thought I'd bring an academic in, talk about some things. We just had Chris on the MTOM podcast, so if you want to learn more about him, but grew up in Pennsylvania and have worked on the Board of Trade, on the floor. You've done all sorts of things.
Yeah, I showed up to the Board of Trade in 1991, came down for a visit, and at lunchtime I got a job offer, and I went back home. 2 days later, I was back and never left.
Never left. And Seth Meyer is in Missouri at the University of Missouri. But Seth, you haven't been there all the time. You've traveled a little bit, but an Iowa guy, which I found out. I didn't know that.
Yep. And then went down to school at the University of Missouri for a while. Went and worked at the United Nations Food and Ag Organization in Italy for a while. And then got a call from the chief economist who asked me to come back and work for him at USDA. Spent a few years there, and then he asked me to run the World Board, so the group that puts out the WASDE report. And then came back home.
To work in academic land.
At the University of Missouri again.
All right. Well, we have a USDA question just for you, Seth, in a minute. I know you have to defend the organization even after you're gone, but we're actually going to ask you both of this one. This one's an acreage report. This one came from Sylvain in Quebec, and I'd like to thank Phil in Ontario for allowing some of his Canadian friends to tweet at us, so we appreciate that. Sylvain's asking, with prices of corn and beans the way they are heading, he says, if it stays, will there be more switch from other crops to corn and beans? Will more acres be planted in 2021, Chris?
Well, that's that old expression, the cure for high prices is high prices. So yeah, if come January, February, March, a guy can take a look and say, you know, I can make X amount of dollars planting beans or corn versus, you know, some other crop. You might take a look, you know, lots of times guys will make a decision, are they going to plant, you know, down in the Delta, are they going to plant cotton or are they going to plant beans? Or are they going to plant sorghum instead of corn? If you've got $5 corn and you've got $13 beans, you know, farmers love to plant corn. So I would say that they'll come for it if it's there. It's like if you build it, they will come.
All right, Seth, do you think we're going to see a little more corn and soybean acres next year and maybe take away from something else?
Yeah, I think it's important to also remember that, you know, this year we had a above normal prevent plant. It just nobody talked about it because of the prior year prevent plant was so huge. So even if we kind of go back to normal planting weather, we'll gain a couple million acres in the planted crops. It would not surprise me to see wheat potentially print a new record low by the time you get spring wheat involved, a new record low area. That wouldn't surprise me. It wouldn't surprise me to see somewhere in the neighborhood of north of 181 million acres of combined corn and soybean area, maybe record large soybean area, given where prices are at today. Unless we see some major change going into the fall, we could see, again, record corn and soybean combined area. You know, we talked about wheat earlier and you know, wheat looking good. And I think the only thing a wheat producer might say is, I wish I was a corn and soybean producer. And we might get a little bit more area that way.
Well, that's the acreage report will come here after the first of the year, and that'll be quite a day to see how that all shakes out. But let's move to Matt in Maquoketa, Iowa. And Seth jumped because Maquoketa, Chris, is not that far from where he's from. But how, and I even said Maquoketa right, that's a whole other story, Maquoketa. Matt is asking us via Facebook, how is the Chinese currency versus the U.S. dollar driving demand? What's your take on that?
Well, I think you saw that battle going on, especially during the COVID spike where the dollar was at an 18-year high. You know, the dollar's just come down to a 2.5-year low. So not only do we have plenty of beans, but relative to the Chinese currency, it was on sale. So it made it way more attractive for the Chinese to come and buy our beans. So it was definitely a help.
I want to move on to Roger in Hancock, Iowa, because I want both of these guys to answer this question. So Roger's asking, earlier in the year he said gold went up, the dollar dropped. If more stimulus comes and with demand up from China with the new trade deal, South American weather problems, how close are we to an inflationary move in commodities that breaks through overhead resistance that has been on the chart since 2013. Seth, I'll let you take a crack at that one first.
Well, see, that sounds like a little bit of a technical question in terms of trading, so I'll avoid that. But kind of tying it back to the earlier discussion about exchange rates, I think it maybe matters when you think about the strength of the dollar and an inflationary move, how we look against the Brazilian currency as well, right? I think that as you think about an inflationary move in commodities, you also got to remember these high prices, are they cooling demand? Are they cooling demand some other places around the world, even if they don't cool demand for China? So yeah, I can see some upside demand if the Chinese continue to buy, but I can also see that if they have secured their needs, that maybe things cool a little bit and we don't see that surge.
All right, Chris, you want to handle the technical side or take a different take than that?
No, I agree with Seth, but also if you just look at the percentage gains off the summertime lows, multi-year lows, cotton's up 45%, soybeans up 45%. So it's already been factored in. I mean, these things move fast. Managed money, they don't really particularly care. If they see an opportunity, they've come in. So you've got the investment community now, they've all bought into this idea, yeah, we're going to have inflation. And why not? Well, for the past 2-3 years, they just, have been printing money, 0% interest rates. They just did the first leg of the support payments due to COVID. Everybody agrees that after the first of the year, there's going to be $1 trillion, $2 trillion more coming down the pike. I mean, it's going to be there. It's just now is who's going to get credit. So the market's anticipating all that. And when you add fuel to the fire like that, we were always taught it's going to give us inflation. So we'll see. I think that is the number one big picture trade guys are looking at moving forward. And if you have a weak dollar with inflation, it should be helpful for our commodity prices, and it should be another tailwind for commodity prices. So are we going to get back up to where we were in 2012, 2013, to come back to the technical question? That was a drought year, but that certainly wasn't a drought year like 88. If you want to see a drought year, 88 was the drought year, right? Let's go back and look at that chart. And then the problem with those years is the drought goes up, and then again, it comes down so correctly. So it corrects so quickly. So I think that, is this going to be a 2, 3, 4, 5 year deal? A lot of it depends on what happens. I think if we continue to have a good recovery, and they can dial back, the government support with having to send everybody checks to keep everybody in business, that's it. But at the end of the day, we were always taught, and I think, Seth, you would agree with this, when you increase the money supply, you're supposed to get inflation. And we've had a lot of increase in money supply really since the 2010 crisis.
Okay. I'd like you to switch gears now a little bit, Chris. Ron in Waverly, Iowa was asking, how much fall 2021 corn and beans should we be selling this week or next?
Well, I think that given the fact that we're at close to 2-year highs in corn and close to 6-year highs in soybeans, if we get above 1208, that's on a spot month, that's going to be a 6-year high. So I think that it behooves you to go out and at least maybe do 5%, 10%, cover your inputs. Now, if you don't want to sell because you're worried about $13, $14, $15 beans, whatever your wildest dreams are, then you need to be hedging. And you hedge yourself one of two ways, either with futures or with puts. And that's a whole other story. But you definitely need to be doing something to take advantage of these prices because, this story could change. Look, we've just rocketed higher in 3 months. 3 months from now, we could be who knows where. What you don't want to lose is this opportunity to you're looking at 2021 beans or 10.50. Nobody should have a soybean sale for 2021 under $10. Same thing with corn. Corn's at $4.10, $4.12. You shouldn't have a corn sale under $3.90, $4. And that is just a hedging problem. And so, yeah, I would recommend doing 5 to 10% of your sales and hold off. We don't know where we're going to be, but certainly you don't want to be in a situation where you didn't take advantage of this rally.
Okay. Seth, I have a question here for you. Go back to your USDA days. Glenn in Bryan, Ohio, asked us via Twitter. He said, in light of all the changes in the recent data from USDA's NASS, is there a persuasive argument as to why USDA reports should still be considered credible or reliable versus the data provided from the private sector? Heard that one before?
I heard that one many times. And when you see these revisions, I think it's a natural question, right? But I think if you also went out and asked those private providers if they wanted NAS to stop doing it, they'd say no. They make their living off the incremental difference between what they say and what NAS says. I'd also add that NAS doesn't have any skin in the game in terms of what they report, and I can't always tell if the commercial providers do. I know there's lots of questions about those revisions. We've seen some big revisions in terms of from the stocks report, which gives you implied use, which may suggest something about the size of the crop. I've seen those revisions, but I will still also tell you that the system in which we produce is the envy of the world. It is hard to describe the concrete benefits to U.S. agriculture as a whole. But let me tell you that it provides every month, it puts everybody back on an even footing with respect to how the market looks. In the absence of these reports, I would argue a few people would know a lot and a lot of people would know very little. And so this provides an important step that even these commercials would say, okay, we're on an even footing now, we calibrate to this, and now we're going to move forward. And here's where I put my knowledge advantage to work.
Chris, did you want to say to that, come on, really? Did you want to answer it that way?
Give us the comment.
It depends. I mean, I make my living working with farmers and producers. So they look at the USDA. The USDA can really only do one thing, and that's hurt them. Every time one of these reports, because a farmer, producer, you're always a net long speculator. You are speculating with one hand tied behind your back because the only thing that can hurt you is lower prices. And then also, you always have the regret after the sale if you sold it and you watch it rally. So the USDA takes the brunt of that abuse. At the end of the day, they are the final arbiter. Now, I will tell you this. There were a couple reports this year that if I had the reports out early, they were extremely bearish. You would have gone broke. So it would have been like if you had the information early, or you thought you knew all the facts, especially some of the whipsaws we saw in soybeans. And that was the first clue that we were having a turn in soybeans, because the market got bad news and it shook it off and rallied anyhow. And we had a couple reports like that. I don't want to get too deep into the woods, but that was kind of a first thing that was a sign. So I enjoy the USDA reports. I think that they're important because they give everybody a baseline. At the end of the day, it all comes down to supply and demand, and we're going to find out, at the end of the year where we're at anyhow. But it certainly is an important checkpoint every month, the 10th of the month, 9th of the month, 10th of the month. It's something I think to look forward to.
That's Chris Robinson. I appreciate your return back to the show, Chris, and Seth Meyer from the University of Missouri. Gentlemen, thank you so much. Enjoy your Thanksgivings. I know they'll be different this year. And the insight today was wonderful. Thank you, Seth. Thank you, Chris.
Thanks.
That will do it for Market Plus. Next week, we'll look at the new battle against an old disease, and John Roach will join us to analyze trends in the commodity markets. I'm Paul Yeager. Thank you so very much for watching, listening, or reading. Have yourselves a great week.